today we're going to talk about non-performing loans, and could you tell us more about how that whole space is doing and what's happening in non-performing loans as it relates to private lending?
Sure. So again, my name is Tae Kim. Thank you very much, Rocky.
Sure.
And I work at the Corporate Securities Division at Geraci Law Firm. I primarily design and help and assist clients in putting together a fund, and the offering documents that comes with it. And to answer your question, when it comes down to a non-performing loan, we have seen an interest and an uptick in terms of wanting to get into the space in the non-performing loan on a more exclusive basis, and that was something that was very interesting when it comes down to how the market is doing overall. Although the economy may be good right now, it's something definitely to think about in the future.
So are there a lot of companies that are forming a fund just for non-performing loans?
Yes, there definitely have been an uptick and very definite interest when it comes down to putting together a fund purely from an NPL basis. And of course, there are different mechanics that comes along with the NPL, given the fact that it has to either be modified or reinstated, and thinking about various exit plans and how this all plays out within the NPL rather than a traditional mortgage fund. And so that's definitely the elements and the issues that needs to be brought up and discussed.
And one thing I can think of with a non-performing loan fund is the complexity of, you don't get consistent monthly payments, right? You purchase a non-performing loan, then you have to get it to reperform, and then so meanwhile there's no income coming in for that particular loan, and the investor just has to wait it out until. So are these generally longer term plays, and how does that all work for the investor?
That's a great question, Rocky. So when it comes down to it, and you're absolutely right, it does take a while. Between 6 to 8 months has been the experience that I have observed from these various lenders and the purchaser of these NPLs. And to accommodate that, there are some backstops and some mechanics that is required for these investor expectations. Some of these mechanics may include a deferred capital return. When it comes down to making it to be a cumulative as opposed to non-cumulative return during the time when they are deferred, such that you wait for these NPLs to be performing, and there are also some of a lockup withdrawals. It needs to be a little bit more tightened up, and these other mechanics behind it is very important.
So if there's lenders that are starting these non-performing loan funds, there must be a demand from investors in these funds that are willing to invest in these funds in order to get these much higher returns over the course of several years.
Absolutely.
And do you think the demand's there, where there's enough investors out there, and it won't be that difficult for these funds to raise capital?
Yeah, I think that the market will continue to shift when it comes down to how these NPLs will be performing. There's always an investor appetite as to chasing that yield and wanting to increase that rate of return. But in order for you to increase that rate of return, as you can see, the yield compression that is occurring in California and other areas because of the competition, you also want to look at different asset class, including NPLs. And so in that, when it comes down to just the general economics of how these, the investments work, greater the risk, the greater return, and purchasing in the NPLs do have certain risk. Now it's up to the investor to determine whether that fund manager is experienced enough, is acutely involved, and can analyze and underwrite in acquiring these NPLs. And so that is probably the main focus when it comes down to investing into these NPLs. But yes, you're absolutely right. The higher the risk, the higher return, and I've seen NPLs that are doing very well.